India's headline retail inflation rate eased to 7.04% in May from April's near 8-year high of 7.79%, thanks to a favourable base effect. The RBI had early revised India's inflation projection to 6.7% from the earlier estimate of 5.7% in the MPC's June meeting. Based on the increase in commodity prices globally, CPI is expected to touch the 6.3% average this fiscal from 5.5% last year. Now, retail inflation has been above RBI's medium-term target for quite some time right now. So even though 7% is a figure which is slightly better than expected, definitely not one to rejoice in from any angle. What does the 7% figure mean, and directionally can we see a further reduction, or is this 1 month of relative relief just a blip? To speak more on this, I'm joined now by Madhavi Arora, lead economist at Emkay Global, and Madan, Sabnavis, chief economist at Bank of Baroda. Welcome to both of you. Great to have you back on the show. Madhavi, let me begin with your take on the 7.04% figure. Are we seeing the impact of, moves like cut in excise duty or ban on wheat exports, etc., feeding into this figure?
Well, the number is a tad lower than our expectation. And as you rightly said, some of those factors have started to play out. I think a large part of that would play out in the month of June, especially the motor fuel cut, which is partly split between May and June. But I think June will see a much more impact of the same. On the other hand, we are also seeing the fact that the rise in domestic wheat have so far, have remained contained so far, essentially on account of the fact that the government had tried to regulate the exports. And I think that should also lead to some respite as far as the upside on the staples is concerned. At the same time, we are seeing some easing in international edible oil prices or palm oil prices, which is again reflect in our domestic food inflation. At the same time, the mandi prices so far, at least in the last 10 days or so, are showing a marginal downtick both in fruits and vegetables, which should again augur well for the food inflation in general. But of course, the trajectory is still, pretty high vis-a-vis the comfort zone of Reserve Bank of India. And I think we may still see a 7% being a sticky number as we go ahead. But at least on the food front, you are seeing, visible signs of improvement.
Persist with the monsoon now coming in. Some elements of the food basket tend to spike during the monsoons as well, your vegetables, etc. Madan, directionally, what is the trend you see with inflation?
Directionally, I think for 1 more month, we'll have the comfort of the base effect. So I think even for a month of June, we may end up with a number close to 7%. But subsequently, I think a lot will depend upon the global environment. When I say global environment, it depends upon what happens to edible oil prices, what happens to metal prices, and probably also crude oil. Though the crude oil pass-through is not going to take place, at least in terms of petrol and diesel, but in terms of other products, there would definitely be an impact. But I would tend to believe that on the whole, we will be moving into the region of around 6.5% for the year, and 1 month of comfort for next month. But then again, we'll be having numbers above 7%, decisively above 7% subsequently. We should also remember that prices of tomatoes have actually gone up substantially. So that's something which has tended to spook the CPI inflation number in the past, and that will again happen this year. And just the last point, I think we are talking of a good monsoon. The government has increased the MSPs rather aggressively this time, especially for things like oil seeds, and to a certain extent also in terms of cotton. So I think this is again going to get reflected in terms of higher inflation numbers, both CPI as well as WPI.
Just on the point of base effect, Madan, I'd like you to explain that in a bit more detail. Why do you think things are going to change significantly after the month of June?
No, actually what I meant was that we had a high inflation number in last June, and the index was at a comparable level as that of May. So given the fact that there will be a certain month-on-month increase in the inflation number for the month of June, I would tend to believe that we'll be having a slightly more docile number for June, the inflation number. But subsequently, we saw that inflation last year had actually started moving downwards. So we had inflation in the sub 6% range. And that's when there will be some kind of a disadvantage numerically. But I think more than the number, I would also be looking at what I pay when I go to my shopping. And as of today, I don't see I'm paying less for edible oils. Definitely for petrol, diesel, we're paying lower prices. But if I look at vegetables, I look at edible oils, definitely I continue paying higher prices.
Absolutely. Madhavi, your take of directionally where we're headed. And do you think that we could see more inflation curbing, moves on behalf of the central government? Is there more in the arsenal after the export limits and the excise duty cuts?
See, all of that will come with a cost. So, it's very nice to say that they would be taking the whole of fiscal cost in themselves. I think it will have to be somewhere, the pain of the war or whatever happening in the global markets in terms of the, spikes that you've seen in commodities across will have to be borne between economic agents equally. So I think government may take a burden of it further, but, at least given resilient growth, at least so far, I think that there could be a further passing on of input cost in output prices, which is also been reflected in PMIs. So I think government would be able to take a part of it again, but I think consumers would have to bear the inflationary burden in terms of retail prices.
Um, in terms of what these numbers are indicating to the Reserve Bank, we saw already a 90 bips increase in just a couple of months. Do you think that there is any base right now to sort of go slow on the interest rate hikes? Do you think the Reserve Bank is done with more front loading, or we'll have to wait and see that CPI print for the next few months to get a clear trend? Madhavi, with that question first.
Yeah, I think there's further more to go as far as the front loading is concerned. However, I'm not in a camp of very aggressive rate hike per se. See, in India, these inflation expectation and the conventional neoclassical theory of managing inflation doesn't really work very well as far as monetary policy is concerned, because to some extent, a large part of the household expectations are managed by policy actions of the government of India. This is what the RBI also said in the last policy, wherein they mentioned that the expectation of household have come off because of the government intervention as far as the fuel prices are concerned. So I think in India the monetary policy is more effective via the credit offtake route, which seems to be still pretty much tepid, even though we are seeing a nominal credit offtake now in the double-digit range. I think it's partly because the working capital is becoming more expensive, but the real credit offtake is still very tepid, and I think to some extent the policy response will have to take into account the fact that we are not developed economies which had faced a very sharp fiscal response, a very strong fiscal response post-COVID, and thus the kind of monetary stimulus withdrawal that may happen will have to take into account the fact that we are still subpar and not in the zone of a very high, above potential growth that, say, the West is seeing at least. In fact, in India, we have still very limited evidence of a wage price spiral that is happening in the West. So I think to some extent, policymakers may still front load, but we'll have to see once they reach a 515 or a 550, whether they are further going ahead with rate hikes. So there could be probably, a bit of a slowdown in terms of incremental rate hikes. So I think at this point, I'm looking at a terminal rate around 575 and effective rate hike of 25 bips because of a tighter liquidity from 3.5% of NDTL to around sub 2% by end of the year. So net, I think not in the camp of a 6% terminal rate as such, but we'll have to see. It's a very, very fluid market. 6 months down the line, the world economy would probably be very different, a space to play as far as central banking is concerned. So we'll see how it pans out. But as of now, I think they could front load and again then slow down once they reach a pre-COVID policy rate.
So, Madan, you think the path to the pre-COVID policy rate is very clear and unfettered, and after that it just depends on a whole host of factors on where interest rates move next?
Yeah, it looks that way, but the only important thing will be whether the RBI will pitch for 50 basis points in the next policy or will it be 25 basis points? Because I think the inflation numbers are going to be more in line with what the RBI has projected for Q1, Q2 for certain. So whether there is going to be this kind of front loading where you take it up to beyond 5.15, probably to 5.4% in the next policy. And we are looking at a terminal point of 5.75%. But interestingly, one looks at the market and look at the OIS rates. I think that actually indicates that we could be looking at something like 6.25, which I think is very, very drastic. Maybe you'll have to see how these rates actually change over a period of time. But 5.5, 5.75 looks a very reasonable kind of path for the Reserve Bank of India to follow for this year.
All of this is the unknowns, how the Fed will move next, what happens in Ukraine, Russia, And are we stuck with sticky inflation for quite some time? But an important number today and a story that we need to track very, very closely. Thank you so much, Madan and Madhavi, for joining us on the show this evening.